welcome back to Bilber Logic. Today we are going to learn basics of option trading. Today I am mainly discussing about option expiries. Like some indexes, ETFs, we have a daily option expiries, where some individual stocks we have weekly, quarterly, monthly only. So today we are going to discuss about those, and as well as about how to pick the strike, and how much we are going to pay the premiums, or how we are going to get paid premiums for some of the strategies, as well as the geeks, like one of the important geek, which is delta. So we are going to see details about delta, and high level about gamma, theta, and extrinsic value, intrinsic value, and some of the strategies. So we are going to cover all those in this video.
And please remember, I'm making these videos only for educational purposes only. I'm not a financial advisor. So if you want to invest on any stocks or options, please do your due diligence before make any investments. So let's jump into basics of options. So first of all, we'll see what are options. Options are not like a stocks. Options are contracts which we have a right to buy 100 shares, but we are not obligated to buy. So options have call and put options. So call option means whenever we have a bias on a particular stock, if that goes up, we can buy, call, buy. If we have bias of any stock is going down or market is going down, if you think an index may go down, we are going to buy a put buy. So let me quickly show you how that option chain looks like. So this is the option chain. Here I am going to take Tesla. So if we see Tesla, so this is the option chain, and this side is like, just let me see, keep only 20 strikes. So this is the call side and this is put side. If we think the Tesla price go up, we can buy a buy contract, call buy contract. This is a buy and call, and we can pick how many contracts we want. But if I think that stock goes down, then I will go with put buy contract. And here in option chain, like basically we need to understand strike price, premium, and expiry. So if we see the expiry means, like in this chain we have a weekly, and some are like these are monthly and quarterly expiries we have. But if you see indexes like SPX, it has expiry like every day, as well as some other stocks like ETFs like SPY ETF and QQQ. ETFs, these have everyday expiries. But when it comes to the individual stocks, we could see we have only weekly, quarterly, and monthly expiries. And secondly, we will see about premium. So what is the premium? So here, like when we buy stocks, we will pay the full amount for the stocks. But here there is a concept of premium. So if you see, there are like a number of amounts, like you see 930, 1060, 1195. These are the premiums. So if we think the Tesla stays above like 472, I'm strong at this price, then I can go with this contract. if you choose this contract, we need to pay 15.5, which means into 100. This is one stock price premium, but here every option contract we have right for 100. So each contract is represents 100 shares. So we need to multiply this into 100, which is $1,505 I need to pay for this contract. So the good part with this, if you buy 100 Tesla stocks, you need to pay 447,000, around $47,000. But in this case, we are paying only $1,500 to for this option contract. So if we see the delta, it has 69 delta. So like it's always good to go with at least 70 and above. So if we go with this based on the delta, so what it represents, if every single dollar move, we are going to gain $73 for this contract. But if you own the stocks, you will get like $100. If you buy 100 Tesla stocks, every dollar gain, it's easy to calculate, you will gain $100. But here based on the delta, you will get $73. But when you see your investment, when you buy stocks, you are going to pay $42,000, where here you are paying only $1,600. But the biggest risk is if this goes against to you, then you are going to lose your entire $1,600 unless you cut your losses early. So next we'll see the this is what premium and this is the strike price. And strike price is the price like where we choose for the contract, basically the level where we are thinking that stock is going to stay above. And next we'll see geeks like delta, gamma, theta and vega. Like gamma, theta, vega like impact our contract, but we mainly good to have a good understand about delta. So delta is one of the most important thing in options trading. So call delta goes from 0 to 1. Put delta go from 1 to 0. So the more delta is like the stock gonna be more stable. So that is why always good to go with the higher delta option contracts. If you take even further up, like if you take this contract which is like a 460 strike price, and the delta if you see it's $1887, which means every dollar move you are going to make like $87. This is very very close to if you own a real 100 shares. And lower delta means if you see this is the lower delta. So instead of you're paying $2,200, you are paying only $300, but where the delta is only $22. So I mean like the delta is only 22, so you are going to get paid for every dollar increase, you are going to get paid only $22. So for you to see good amount, you the stock should go like more, like maybe $10, $20, $30, then you will see some profit. So it's always suggestible to go with at least above 70 delta, because we need a big move to make money if we take this kind of low delta contracts. And then we'll quickly see other geeks like a gamma, theta and vega. Theta is time decay, like our option loses value as every day. Like imagine you take this 17 April So 20 around today you are going to take an option contract. Today it has a more value. As like after a week, it loses that option contract value based on your time decay. And gamma means how fast delta is changing. Gamma will change how fast delta is changing. Like some days we will see the stock going sideways, some days it goes like we'll see like a huge move, like a $20-30 move, and some days we'll see like the stock fall down like $20-30. So that is going to impact gamma. And vega measures like a volatility impact. High volatility equal to high premium. If we see more volatility, one day like the Tesla goes like $10 up, $5 down, again $10 up, again $10 down, that is like huge volatility. Those days premiums will be very high. If you see a stock which is like going sideways, most of the times the volume will be very low and the volatility will be low. In those days even the premiums will be very low. And premiums have like intrinsic value and extrinsic value. Intrinsic value means real value if the trade was exercised right now, and extrinsic value is a time plus volatility plus demand. Closer to expiry, the intrinsic value is going to drop and premium is going to collapse. So always suggestible, if you open like a contract for 2 months out, it's always good to close after a month, like half of the time. Otherwise, even you are right, even your option is going in your direction, still you may lose some money. So it's always good to close within like a month once you open. Like if you go out like a 2 months, it's good to open in a month. If you open a contract which is 6 months out, it's good to close like within 3 months. If it is 1 year out, it's good to close at 6 months. So it's always good to close early, otherwise it loses that extrinsic value, and premium collapse a lot as it goes close to the expiry. And in options we have some strategies. Like if you want to go naked calls directly, we can go to, like if you are bullish then go with the call buy, if you are bearish then go with the put buy. But sometimes the premiums are very high and we may don't want to risk that much money. In that case there are some alternatives like credit spreads, where you are going to buy and sell of the call, or you may buy and sell both legs of the put. That is called vertical spreads. So in those cases, like your risk is more going to capped with your other leg. And another thing we can do like a cash secured puts. Cash secured puts means you are going to get like the stock with the discount price. Or if you already have 100 shares like for a particular stock like Apple or Nvidia, any stock, if you want to do covered calls, you can do covered calls where you will get the premium. I'll quickly show you those things. Like suppose I want to buy Tesla, I want to own Tesla of 100 shares of Tesla. I don't mind to own, as I'm more confident and bullish on Tesla and their business model, their innovations, everything I like. So if I want to buy, I can buy. But I'm thinking this 482 is more price at this moment. So what I can do, simply if I say, if I want to get some discount when compared to today, what I can do, and if I think like 450 is the right price for me to buy the Tesla, I can go with this strike, say this is put and sell, say put sell, I just want to buy only one contract because each contract represents 100 shares. So please remember, if you leave 10, which means you are going to buy 1000 shares, so which we don't want to. Then make sure choose your contract number. So I want only one contract for 100 shares. So if I do this, I will get paid $500. And if I say confirm and send, if you see, the max profit is $500, the max loss is 44,495. Why they are saying max loss is 44,495? They will consider, imagine if that stock comes to that price, like a 450, and you will get assigned, and after that if it goes to zero, those chances are very very low, especially when it comes to the stocks like Tesla, Nvidia, like Palantir. That is very rare, that's not going to happen most of the times, but they will give you the real worst case scenario. And always when you do cash secured puts, do only the stocks you are believing so much, otherwise just don't do it. In If you don't know about the stock and their business model, like in that case that stock may go down to zero, so you are going to lose your entire, like 100 stocks value. So just be careful when you do this cash secured puts. So this is one thing. And you can do covered call, which is imagine I already have 100 shares of Tesla. In that case, I can just wait, like how long I want I can wait. The price may go up, but sometimes the prices will go high and then will go down, and just holding stocks like that, you won't get anything. So in those scenarios, what I can do is a covered call, which will give me a passive income, like monthly income, or you can choose even for that your expiry. So if I go with like imagine I have 100 shares of Tesla, which the average strike price what I got, like 450 or something, then I'm okay if I get anything above 450, right? Because I'll be in profit. So in that case, if you want to do aggressive, like if you want more premiums, you are okay to your shares to get called away, then you can go in the money, where you will get like 482, like 485, you are fine to, like sell your shares, because you got it only for 450. Then you can choose the strike price, and then you will get paid. Okay, so if you see call, sell, and you have only 100 shares, go with one contract, so you are going to get paid $1,480 for this contract. You will get paid ahead. And if that expiry day, like day of expiry, if that stock stays below anything 485, they won't buy your shares, this premium is yours. But if that stock goes anything above 485 point even 1 cent, your stocks shares are going to called away, and they will pay $485 for your each share, which you are going to get 48,500, and this premium is yours. So this is one thing. So like this, if you want to aggressive, you can go in the money, but you want to hold the stocks, because you are believing so much in Tesla and you want to keep those stocks, but still you want to make some income, but you are not as aggressive like about income, but your preference is hold on to the stocks, then go with the lower strike, which is like take it like 512, which like even if that goes above, then you will get paid a lot because your stock price is only 450 and you are going to get paid $512. So you are going to make around $62 for each stock, which is like $6,200 for your 100 stocks, and you are going to get like $600 premium. Even you don't want to do like go you want to keep your shares, you have another option, which is rolling your contract further strike. That you can do, but you should not wait until the price reaches to 512. If you see the price around reaches to 500, like between 500 and 505, and if you see the momentum in that stock, you just right away try to roll like from 512 to like maybe 520. Then later, if you think like that's still going up, then you can roll your call even like higher strike. So there is an option, but you have to be like alert, like when like you have to see the price, like okay, if it is coming close, it's you want to keep your shares, it's good to roll ahead at least $10 like before it reaches to your strike price. But if that strike reaches to like a 520 or above, then I mean still you can roll, but it doesn't make sense. You have to pay back your profits. But still, if you think that is a good thing to do, yeah, you can go ahead and roll it, but always suggestible to roll before it reaches to your strike price. And this is like one of the strategy. And you can buy just try straight naked puts, naked sell, like call put, call buy. You don't want that, you don't want to invest too much money, then go with vertical spreads where you are going to buy both legs, which is call buy, call sell, or put buy or put sell. And if you want to buy shares for discounted price, you can do cash secured puts. Or if you want to do like you already own the stocks and you want to get the passive income on those stocks just like a rent, you can do covered calls. So those I'm going to make in detail video, like how to roll or like how to pick the strike price. And like I'm going to make separate call for video for cash secured puts, which is CSP, and as well as covered calls also we can make another video. And options are powerful but very risky, so avoid, like some tips I want to give: avoid cheap and low delta options. Like when it comes to call buy or put buy, make sure go with the higher delta. But when it comes to the cash secured puts and covered calls, go with the low delta. And don't hold options too close to expiry. When it comes to call buy and put buy, always manage your position size. Don't jump with the like two contracts, three contracts. It's hard to manage. It's going to hurt your portfolio. And always good, if you are a beginner and you don't have a much time to analyze about stocks too much, just don't go which you don't know. Just go stick with like a spy, like ETF, like a spy, QQQ, or Tesla, or Nvidia, Palantir. Like even some um small stocks like a sofa is a really good stock. Like those kind of stocks you can choose, but just don't go like which you don't know at all. This is all about today's video. Hope you enjoyed this video, and I'm coming up with my next videos about vertical spreads and cash secured puts and covered calls, all those things. And please make sure subscribe to my channel and share with your friends. Thank you.